Great. Well, thank you so much for putting us on the program. Thanks to Matt for stepping in on like 48 hours notice and banging out a discussion. This paper is joint with Dave Solomon at Boston College, and we actually came up with the basic idea for this paper and our dividend disconnect paper over a morning of skiing at the Utah Winter Finance Conference a few years ago. So it's great to be back and present the finished product. So this is a paper about how investors have performance presented to them, how that impacts their perception, and ultimately how it impacts aspects of the market. So before we get there, let's just briefly talk about information display and its impact on behavior. So at this point, there are a bunch of examples people have come up with of what are known as nudges. So basically, you just change how things are presented to people without necessarily changing the information set or the choice set, and just changing that can influence their decisions quite dramatically. Now, while that's really important for individual decision making, this is the type of thing we typically assume doesn't necessarily have a large impact on market dynamics, because of course sophisticated investors can undo the effects of individuals who may be influenced by such factors. And so there are a bunch of facts that seem suggestive of kind of market biases, predictable pricing, but most of these don't really suggest a role for a nudge. So they're complex tasks, they're uncertain, they're things that people aren't paying attention to, or they just have too much information to discern what's going on. And so none of those are the types of things that you would expect a simple nudge would correct. So what we're going to look at in this paper is an investment's performance. And so an investment's performance is going to lack any of these attributes, because it's about as attention-grabbing as anything in the market. And of course, there's an agreed-upon metric to quantify it. So how do you measure your investment's performance? Well, about the most boring thing you could put in a finance talk, unless it's written that way, is actually a return definition, which is, of course, price minus lagged price plus the dividend scaled. And let's see what happens if we do a little algebra, also a bit crazy. So if you did a little bit of algebra, you could split that component into a price change component and a dividend yield component separately. Now, of course, we know that that's not the right thing to do conceptually. So when a stock pays a dividend, the price drops by roughly the amount of the dividend yield. So there's kind of a mechanical relation, which is why we combine these together. So conceptually, it's wrong to do that, and economically, it's actually important too. So this is just a dollar, the value of a dollar investment in just the crisp value-weighted price change or just the crisp value-weighted dividend yield. And so the monthly average is about 30 basis points for the dividend yield, about 60 basis points for the price change. Both are kind of economically relevant. And of course, above and beyond just looking at the price change, you want to be looking at both of these, combining them and reinvesting them. So this red line of the price change makes it to about $150. If we were looking at a cumulative total return, it would be like $5,000. So it would have a large impact overall. So all of this is just to say, we know how you should look at performance. We've got a simple formula. It's not especially controversial to do so, and that's the way we should be doing it. So what we're going to do in this paper is we are going to look at how investors actually see performance. So how is performance actually displayed? And what we're going to find is that it's almost impossible to find that academic return definition in the wild. Now, it's not that this is like private information, or you can't search and find it, but the default metrics shown to investors are not going to be a return. We're going to focus on major market indices because this is going to be a really clean test of the visual display of information. So major market indices in most developed countries are price indices. They totally ignore dividends. They are not return-based indices, which we think should be the appropriate benchmark. Now, they're going to be a clean test because most people who view the index, if you go to the Wall Street Journal or CNBC, you see the Dow, you see the S&P, you don't need to hold the index to be viewing it. So lots of people look at this performance information and don't hold it, and even those who do hold it are typically going to do so through an ETF or a mutual fund. They're not going to be receiving a daily stream of dividend payments, which could confound some of the effects when looking at individual positions. So we're going to show you that it's the case that they kind of look at these weird benchmarks, but doesn't matter. Do sophisticated investors kind of back out the appropriate measure and undo any effects? And we think this is important because the fundamental assumption of basically every asset pricing model, before we get to kind of the more complex stuff, is that people actually view returns, and that's what they're making decisions over. So what we're going to do is we're going to look at a bunch of cases where it seems to be that people are being influenced by the display that they're being shown. We're going to start by just looking at the financial press and how they discuss performance. And what we're going to show you is that the financial press seems to be responding to the market indices that they're shown, not actual market performance. So basically, conditional on the level of actual market performance, the press gets more negative the higher the dividend yield was. Next, we're going to look at capital allocations. We're going to say, how do mutual fund investors allocate capital based on a very funky benchmark, which is going to be the change in NAV relative to the S&P 500 price index. Now, these aren't two numbers that should be compared, but they are numbers that are shown together a decent amount. And so we're going to show that if you beat this kind of nonsensical benchmark, you get about 50 basis points higher flows for the next calendar per month for the next calendar year. Then we're going to move on to security prices. And what we're going to show you is that if you look at the market betas of portfolios, that seems to vary a lot with the price indices, but misses a lot of the dividend components of performance. This is going to suggest that there's an underreaction to market performance on days with higher dividend yields. We're going to find that the market performs better on days following high dividend yields. And we're going to look in the cross-section, and we're going to find that high beta stocks perform better as well, too, consistent with kind of an underreaction to the dividend component of performance reversing. Now, if what we're capturing is the display of market indices. So most markets show a price index, but Germany is an exception. So Germany shows a total return index, and we're going to repeat the analysis in Germany, show that nothing works there, consistent with capturing the impact of visual display and not some other kind of underlying economic process. So how could this be missed? We all know Miller and Modigliani. We've all had this beaten into our heads. And what I'd say is that makes it very difficult for us to understand kind of how people view this if they haven't had it beaten into their heads. So what we did is we went back and looked at the academic literature prior to Miller and Modigliani. And what we found is that it was very confused. So in that early era, there was a lot of kind of disagreement and confusion in terms of how to think about performance. And that is the era that these return indices date to. And it seems to basically reflect that confusion from the time period. We think we've got a pretty straightforward policy recommendation. Basically, a nudge for the market should be that the default market indices should be total return indices. These exist now. They just aren't what's being shown. And we would expect everything to go away if they just showed the appropriate performance index. So the paper is going to focus on things that we can identify that are being shown by the visual display. So for example, daily market movements, things like that. But we think that there's kind of some larger implications. If people are getting kind of the market performance wrong, systematically lower, you'd expect that things like the perceived equity premium could be different. This also opens the door to kind of marketing of financial products, shifting around strategically using display environments, and suggests that they can have a kind of a broader impact. So how is performance actually displayed? So this is just an example of a brokerage statement. This is Schwab. This is pretty standard to what we found. There's kind of a combined bit at the beginning. Later, there's individual positions. If you look at the beginning, there's kind of a price change bit, or sorry, there's a kind of aggregated dividends. There's aggregated price changes. There's not kind of an actual academic return type row. In terms of individual positions, same thing. There's kind of price changes, there's dividends, they aren't combined. You could kind of kludgily back out something like a return, but it would take a little work, and it's not the default measure. So we went and looked at a bunch of brokerages. This is basically what we found, the exception being interactive brokers. So interactive brokers caters to a slightly more sophisticated audience, and they actually know it. So if you go to their website, they will advertise that unlike other systems, we give you the tools and reports you need to focus on your investments, and they list that they show returns. They had to come up with a different term for it, but this is kind of a competitive advantage that they offer and other people don't. So then we went and looked at a bunch of different websites. So we did a ticker search for GE. And basically, none of these websites showed kind of a standard return on the default landing page. The one, and the other thing we found is it's very difficult to back out exactly what it is. It took a lot of effort. And so, for example, Yahoo shows different numbers for NYSE stock and NASDAQ stock, doesn't document this anywhere. But you can go through and kind of back out what it is, and we think this is suggesting that investors really aren't paying a ton of attention as to exactly what they're being shown. Otherwise, it could be specified. What about more sophisticated guys? So if you go to Bloomberg and do our ticker search exercise, this is the default measure, or the default menu that comes up. And what you can see is there's a bunch of accounting stuff, but there's this bit about kind of this GP line chart, and this just shows you past price changes. So the default in Bloomberg is, again, just past price changes. Now, it's not hard in Bloomberg. If you know that there's a TRA tool, it basically does the same thing, shows you total returns and past price changes. And so if you want to, you can go and you can find it. But again, the default isn't that. And that's kind of our message through this, is it's not that it's impossible to find returns, but you've got to dig, you've got to really want to find them. The default tends to be price changes. So that brings us to market indices. So the S&P 500, the Dow Jones, these are the standard ones in the US. So for anybody who doesn't know, neither of these are return index. They just totally ignore dividends. The Dow Jones is particularly weird. So it is a price-weighted index. And I kind of defy anybody to think of an economic application where the right answer to solving it would be use a price-weighted price index, but that's the most commonly quoted one in the US. And then if you look abroad, this is what the Financial Times reports every day. So none of the US indices are return indices, they're all price indices. If you look abroad, most other countries tend to report price indices, not return indices. The exception being the German DAX and the Brazilian Bovespa. So those are kind of the two exceptions in this list. So why is that important? Well, because basically the market price index is going to be systematically lower based on the level of the dividend yield going X. It's basically going to miss this dividend yield component, and the price change is going to be lower by that amount. And so because of that, there's a mechanical inverse relation. On days the dividend drops. So as Ricardo kind of talked about, we're looking at X days. There's no information here. These were announced a few weeks ago. This is just a purely ad hoc split of performance that's been pre-announced. So this shouldn't be relevant to investors. So the first thing we're going to look at is how do people talk about the market. We're going to look at basically the New York Times tone that we stole from Diego's website. And so if the news is focusing on these price indices, not on actual performance, we would expect that that's what tone is reflecting. So what we've done is we've regressed a simple positive word minus negative word tone measure on actual performance the prior day of the S&P 500. And the first thing you find is if yesterday the market was good, today the press is really positive. And so that isn't surprising. What's surprising is that conditional on the level of performance yesterday, the total return, the reporters get more negative the higher the dividend yield was yesterday. Now, this is exactly what you'd expect if they're paying attention to the reported S&P 500 and not paying attention to actual market performance. So that's reporters. How about capital allocation? So this is what happens if you go to Yahoo and look up the Fidelity Magellan Fund. So what we've got here is a change in NAV, and you can really see it for this guy because they paid out big capital gains. So that's why you get this really concerted drop here of both the dividends and capital gains being paid out. Now, if you wanted, you could add a comparison series. We chose the S&P 500, and now you've got an S&P 500 price index without dividend reinvestment. So these are two measures that aren't really economically comparable. The change in NAV excludes dividends, also excludes a lot of other stuff. The S&P 500 price index excludes dividends, but isn't, again, a good comparable benchmark, but it's one that's out there. So does this matter? Does this have an influence on fund flows. So first off, you can find this, this picture done right. So for example, Morningstar, fund prospectuses will do it right. So it's definitely an empirical question about which one do investors tend to use, and also sophisticated investors might undo the effect of the unsophisticated investors and lead there to not be an effect. So we're going to examine a dummy variable for beating the S&P 500 based on the change in NAV. We're going to do this once per calendar year. We're going to run a monthly regression on fund flows on the dummy variables of beating this benchmark, and then we're going to put in a bunch of controls. So if you run that regression, you're going to find that beating this kind of nonsensical benchmark that does get shown gets you about 50 basis points per month for, again, the next 12 months. Now, clearly this is correlated with actual performance. And so what we wanted to do was make sure that this wasn't capturing kind of actual lagged returns. So we just tried to throw in as much as we could. We put in 72 lags of levels of returns, 72 lags of market-adjusted returns. We put in percentile measures. We put in squared measures. And none of these things seemed to really drive it out. We also controlled for a bunch of specific fixed effects about dates, funds, date by objective. In general, found similar results. So you can dig down a bit further and look at what happens around the break point here. And so what we've got is the residuals from that regression, where the blue bars are you beat that benchmark, and the red bars are you missed it. And what you can see is there tends to be a jump if you just kind of were over this benchmark as compared to below it. And then in the paper, we're going to run some more formal RD-type tests and find that indeed it looks like there's a discontinuous jump when you beat that index. So it looks like the financial press is kind of confused by the market display. It looks like mutual fund investors are confused by it. So now we're going to move to kind of market dynamics. So market beta intuitively is capturing how people perceive, say, a portfolio to move with market performance. And so if market performance is kind of being viewed through the wrong benchmark, that could lead there to be kind of a biased influence of betas. So all these equations are a bit funky. So the standard regression to estimate a portfolio's beta will, of course, be something like the return on a portfolio on the return on the market. So that's just the standard regression. We've all run it probably thousands of times at this point. And so we're just going to take that equation as the null hypothesis, that there's a single market beta with respect to the market return. So what we're going to do, in this very confusingly thing up there, is we're going to split the market return into two components. So you can think about regressing a portfolio on just the price change and the dividend yield. So in the same regression, but allowing for both of those things to be separate. So the price change there and the dividend yield there. So under our null hypothesis of that standard regression, it's got to be that the beta on the price change and the beta on the dividend yield are the same. Now, what this assumption is saying is that the market beta is, and we're going to be looking at daily regressions, daily returns, that the market beta does not time vary with daily dividend yields or daily price changes. Equivalently, basically, the dividend yield and the price change are orthogonal to that error term. Now, in terms of what we've done before, this is not the way people typically estimate this equation. We could not find an example of anybody running something like this. It doesn't mean that it's impossible to write down a model where agents did care about this, but to our knowledge, none of the standard models imply that this should be an informative test, and no one's really thought about running this regression in this way. So what we're going to do is we're going to run this regression because we want to know if people are looking at the market as a price index, basically, is there more variation with that index rather than with total returns? So we're going to run the regression on daily data. We're going to use the FAMA French 25 as our left-hand side variable. S&P 500 price index is our price changes. Dividend yield on the S&P 500 as the dividend yield. So if we run that, what we find is that the mean beta on price change is about 0.9. The mean beta on the 25 on dividend yield is about 0.4. Now, you can do a pairwise test of those 25, and you'll find the difference is about 0.5, the t-statistic of about 8. So it looks like the beta on the price change and the dividend yield do not appear to be the same in the data, which is inconsistent with that null hypothesis of there being this single beta on the market returns. Now, all 25 of the price change betas are positive and significant. We actually found that 16 of the dividend yield betas were insignificant. Now, something you might be thinking is this just capturing something about the differences in distributions of the data? So price changes and dividend yields are quite different empirically. So what we're going to do is we're going to run a simulation to try to figure out what's going on. So we're going to take actual data. So we've got kind of the returns, the dividend yield, and the price change. And then we're just going to randomly sort the dividend yield. So a given return is matched with just a random dividend yield from the sample. Then we're going to subtract that off to get a pseudo price change. Then what we're going to do is we're going to do this 10,000 times, repeat our regressions, and see what we find. So in those 10,000 simulations, the mean is 0. I think that's not especially surprising. But if you look at the magnitude, the 90th percentile is about 0.2. In our data, the difference was about 0.5. So it seems like what we were finding is pretty extreme. I mean, in our 10,000 simulations, we only found 12 that were bigger than the 0.512 in the data, which we think is suggestive that it's not, kind of obviously being driven by these differences in the properties of these two variables. We can also look over time periods. We found that this thing's pretty stable if you kind of split it into 3 different sections. That includes the most recent time period, and we will repeat this in Germany. This is going to be the period that kind of we're going to look at for the German market. You might ask, do we cherry pick the Fama French 25? They seemed like a sensible starting point, but we went and downloaded a whole bunch of different portfolios, ran it for all of them. Some are a bit bigger, some are a bit smaller, but in general, kind of the main message is the same. The beta on price changes is always significantly bigger than the beta on dividend yields. Okay, so now let's turn to Germany. So in Germany, they actually have a total return index as the baseline. Now, if it's the case that what we're finding in the US is based on a price index being shown, well then in Germany we wouldn't expect to find any of these effects. And we'd expect the beta on price changes and the beta on dividend yields to be about the same in Germany. Now, if the results are driven by some economic process that we aren't aware about, well then it probably should be the case that in Germany you get a big beta on price changes and not on dividend yields similar to the US. So we're just going to do the same thing using German markets and German portfolios sorted on size and value. And basically we're going to find in Germany there isn't a statistical difference between the beta on price changes and dividends, which is exactly what you would expect if what we're capturing is the impact of information display. Now, if basically the market performance is coming through dividend yield, there's an underreaction to it. If there's an underreaction, you'd expect it to subsequently reverse. So what we're going to do is we're going to look at the market return today based on the dividend yield yesterday and see if we get this positive pattern consistent with the reversal. And we're going to find that indeed it is. So if you regress the market yesterday on the dividend yield today, you're going to find this coefficient of about 1. So what does that mean? It means a standard deviation increase in the dividend yield yesterday leads to expected returns about 2.6 basis points higher on the CRSP valuated index. Now, the expectation on that unconditionally is about 4 basis points. So the market's about 60% higher in expectation after a higher dividend yield yesterday. You might be worried, maybe this is just something about market performance yesterday. It doesn't seem to be the case. We can put that in. You might be worried, maybe it's something about price-dividend ratios, more slow-moving trends. We can put in a year-by-month fixed effect, again, find similar results. So this is just kind of graphically showing a simple trading rule. In the red line, you're in the market if yesterday's dividend yield was above 0.5 basis points. In the blue line, you're in the market if you're below it. And so you can see that over time, investing in the market on the days after a high dividend yield earn you a higher return. Again, if you're worried about time series issues, you can do the exact same thing, splitting on median within the month. So then you're perfectly balanced across time. You're going to find a very similar picture. We can redo this analysis in Germany. So if we're capturing an underreaction based on information, we wouldn't expect to see it in Germany. We don't see it in Germany. We also have a cross-sectional prediction that the degree of underreaction should vary with the beta of a stock, because the underreaction is basically a stock's beta times the dividend yield that it missed, looking at the market index. So we're going to look at a beta-sorted portfolio. We're going to go long the highest decile of beta, short the lowest decile of beta, and then we're going to look at how that performs based on the prior day's dividend yield. So if you run that regression, you'll find first off that high beta stocks underperform low beta stocks, which is the betting against beta anomaly. So that's absolutely in this data. But that this difference gets less and less based on the dividend yield the prior day. And what we find is the underreaction should be roughly the amount of the beta spread between these portfolios, and the average spread in beta is about 1.2, and the coefficient is about 1.2. You can sort this based on the things we were looking at before, whether the dividend yield yesterday was high based on median or past basis points. And you can see when yesterday's dividend yield was high, basically betting against beta isn't really there because this reversal going on. Okay, so how could this happen? We all know it should be returns. What's going on? So what we did is we went and we looked at the academic literature, and we wanted to figure out how people were thinking about performance. What we found is Miller and Modigliani really codified this concept of returns, called it returns, and gave us a formula. And you can say that they said the irrelevance of dividend policy given investment policy is obvious once you think of it. Obvious as the proposition may be, however, one finds few references to it in the extensive literature on the problem. So before this, people did use the word return. It kind of was loosely used to mean performance, often about stuff like income yields. So there were some papers that were looking at returns like things, but they didn't really know what to call it. Some called it an overall yield, an advantage of stocks over bonds. There was one paper in 1928 looking at preferred stocks, and they basically were very close to kind of our modern conception, and people basically ignored it. So it was cited 3 times until 1950. So what we did to just kind of show you that this was going on, at least linguistically, is we did word searches of kind of the major journals up until over time, and we just looked at the usage of stock price and stock returns in a whole bunch of different ways. And so this is just the ratio of stock price usage versus stock return usage. And you can see that at the beginning of the period, people were basically using the word stock price a lot more than stock returns, whether you're looking at the title or the full text or the abstract, or whether they were close to each other. Then Miller and Modigliani happened. People kind of knew what to call it, and all of a sudden the usage of stock and return became a lot more prevalent. So in this early period, people thought of different ways that you could earn profits from your investments, but they thought of separate ways. So for example, in Hardy in 23, basically says if you purchase a security, you can try to earn dividends, you can try to profit from price changes, or you can gamble. And these were alternative ways to profit. They weren't really combined into a single variable. And so these early market indices weren't trying to capture total performance. They were thinking of price alone as kind of the fundamental variable, and they were trying to be price indices. And because of that, at least from the vantage point of modern finance, they made some weird choices. And so the Dow Jones dates to the 1890s. This is what people were thinking of at the time. This is similar to an index Mitchell created in 1910. The S&P dates back to the 20s, and they still persist in this kind of weird historical way because that's what we thought at the time. So this leads us to, I'd say, a straightforward policy implication here of the market indices that are commonly quoted. There's no reason they aren't total return indices today. So these indices already exist, though somewhat recently. So the Dow Total Return Index wasn't in existence till 2011. And so investors can keep on ignoring what's being shown to them, but if they're shown the right thing, they'll respond to that. And we've just got this kind of weird historical accident in terms of what's being shown, in terms of maybe the most attention-grabbing aspect of market performance. And we definitely think that it should be shifted towards total returns. So that's what we got. So again, the main takeaway is returns are not something that's typically observed. It seems to have to impact a bunch of different decisions, and the market could use a nudge. There's just no reason why we don't switch to total return indices is the default, especially with the market. And we think that this has, it's a kind of fundamental question in how market performance is viewed. And there are a number of kind of interesting applications to it, maybe about some cross-sectional asset pricing that Dave and I explore, kind of like Chiron explores in his paper. There's an interesting paper about marginal propensities to consume. And so we just think that there's a number of things that this could be useful and interesting to think about, its impact. But hopefully we'll switch to the return indices and we won't have to learn about it.